IDFC Mutual Fund is focused on three key areas. The first is to offer distinct, well-designed products. Each of our funds offers a very specific investment opportunity to our customers and is managed in a way that keeps us consistent and true to label. The second area is to offer a very convenient investment process where we use digital technologies to help both our partners as well as our investors access our funds very conveniently and easily. The third area of focus for us is to keep our communication very simple and relevant. In doing that, we use a lot of learning tools as well as communication that is relevant and timely so that investors can benefit from the investment opportunities that our markets present. The IDFC Tax Advantage Fund has the flexibility to invest across market caps. So it currently has a portfolio which is a very judicious mix of large cap, mid cap as well as small cap companies. The fund manager, Mr. Dylan Pinto, is focused on earnings quality as well as the management of the companies that he invests in. Since its inception in December 2008, the fund has delivered a compounded annual return of 18.28%, handsomely beating its benchmark. It also means that 1 lakh rupee invested then is now worth 5.8 lakh returns, which means this fund has delivered actual wealth creation for its investors. The credit markets have faced a fair bit of challenge over the last 6 to 9 months. Following a default in a very large financial services company, some of the other groups have also been faced with some challenge or the other, largely relating either to credit issues or liquidity and concentration issues. Now, till we see the signs of this stress abating, we don't think it may be judicious for the retail investor to start participating in that part of the market as yet. Of course, needless to say, once that opportunity arises, we should be considering that, but keeping in mind that liquidity in this segment tends to be very important when considering investments. Having said that, another part of the fixed income market does offer very attractive real returns. With yields being reasonably high for the levels of low inflation that the country has seen, it means that attractive real returns can be made when choosing bonds or investments which are of very high quality. So we prefer bonds in the 5-year AAA corporate bonds as well as sovereign and state development loan categories. And we think that this is as good a time as any to invest in such investment products. The recent earnings season seems to indicate that industrials, including construction as well as the cement sector, seems to be having some amount of headway with their earnings. We also think that within corporate banks, while the earnings in the last quarter might have been muted, the rebound will be quite sharp and therefore it could be an attractive sector to look at. Consumer discretionary, also benefiting from the organized sector gained prominence, would be also an area where we can see growth going forward. Among the sectors that have been impacted of late, clearly there has to be the auto sector, which has been witnessing some amount of slowdown. Consumer staples again continues to be impacted with earnings growth being weak. And IT of late, while there has been growth behind it, has been impacted by the INR as well as some amount of order book being modest. It may still take some time to show strong recovery in the next few months. The budget season often gets a lot of discussion going around personal finances and where should one invest and where not. Frankly, it's the statement of the finances of the government. It does have macro implications and it does have some implications with respect to how much tax you are going to pay or save. But for the long-term investor, I would question the amount of immediate impact the budget should have on the way you think about your investing.
Frankly, if there are macro impacts from a budget, let the specialist decide in choosing what type of allocation or which type of industry one should go overweight or underweight. But as an investor, it should not really dramatically change the way we look at a savings or our investment objective.
At IDFC AMC, we have a unique proprietary model for selecting the equity stocks we put into our portfolios. It's called the 7-factor model within our house. Now, what is the 7-factor stock selection model? Firstly, we look at 3 quantitative factors, which are earnings growth, relative valuation, as well as the financial track record of the companies we select. We then look at some of the qualitative factors, including what's the competitive position of that company, what's the scalability of the business, what's the sector outlook on that for that company. And lastly, and very importantly, we look at management quality. In an emerging market like India, it is very important that we have confidence in the management before we buy a company. Now, each of our portfolios has a tilt using 3 or 4 of these factors as the primary weights for that portfolio. So, for example, the Sterling Value Fund will have a higher weight for relative valuation as compared to, let's say, the multi-cap fund or the core equity fund. So while we have a consistent framework that helps us select the stocks, each portfolio within the funds that you choose are still distinct because the relative weight for these 7 factors is different within each portfolio. When looking at current valuations, it's important to see how things have changed since the last market high of January 18. Since then, while the Nifty has moved up almost 14%, the mid and small caps have actually gone down by 15% and almost 30% respectively, which means that compared to that period, relative valuation of Nifty at 20 plus forward earnings is at a much richer level than relative valuations for mid and small caps. So from a valuation and an earnings standpoint, we do think that there is better value today in the mid and small caps. Now looking at macro factors, with oil under $60, with yields falling to 7 or just under 7%, with the global macro outlook and backdrop that we have and some of the earnings data that we are predicting, we think that these circumstances may favor cyclicals having a sharper rebound coming back. So at a generic level, we prefer cyclicals as well as mid caps in the current environment. For all of you investors on this exciting digital platform of Groww, I'm certain you want your money to grow as well. Having been an investor in the markets for many decades, let me just share a few of my personal learnings with you. The first is, don't let your money sit idle. Keep the sauce stirring so that you don't lose the opportunities that the market offers you. The second is, have a clear objective for your goals, and it's fine for you to have multiple goals. So for instance, if you're planning a vacation next year, your objective as well as your allocation, your risk profile, your liquidity needs for that portfolio is very different from, let's say, saving for your retirement or saving for your child's education or marriage. So be very clear and specific about each investment objective and have a portfolio designed for that objective. And the third is that it's fine to start small and build up gradually. As they say, little drops make the mighty ocean. So often, don't wait for a large amount to aggregate before you start investing. Invest regularly. Let the investment journey be consistent. It's fine for it to be boring. It doesn't have to be exciting. But then you will realize that the discipline and consistency of long-term compounding adds
documents carefully.